Now, in most other businesses, you're going to end up paying taxes on that $5,000. But with real estate, enter this non-cash depreciation expense. Let's just say you have a $6,000 depreciation expense, just for the sake of argument, totally realistic. And at this point, you'd have a loss of $1,000 for tax purposes, meaning you're not paying tax on any of that income. You have this loss now. So that's the first benefit that's available to real estate investors, is the ability to increase your income without increasing the amount of tax that you're paying. So if you're just say you buy a $500,000 property, for example, and you're able to allocate, let's call it 25% to property with a class life of less than 20 years, right? So you're looking at that's $125,000. Now, with 100% bonus depreciation, you'd be able to take that entire deduction in the first year.
Hi, everybody. Jose Luis Morales here. Welcome back to another episode of the Morales Group Show. Today, we have a very special guest. His name is Thomas Castelli. He is a CPA based out of New York. I'm kidding. New York. Today, he is going to be talking to us about tax strategies for real estate investors. He's going to be going over depreciation benefits. He's going to be going over real estate professional status. He's going to be going over 1031 exchanges, opportunity zones. This is definitely an episode. If you're in real estate investing, this is definitely an episode that you want to watch to the end and make sure that you get all of the different tax strategies that real estate investors are using. Welcome to the show, Thomas. How are you?
Good. Thank you for having me on today. Really excited to be here.
I'm excited as well, too. So for our viewers that don't know who Thomas Castelli is, and I hope I'm pronouncing it correctly, who is Thomas Castelli, and then how did you get involved in this wonderful world of tax strategies for real estate investors?
Absolutely. So my name is Thomas Castelli, and I kind of started my real estate, my journey into real estate actually while I was in college for accounting, right? So what happened was I was going to school for accounting, and I kind of realized that lifestyle of, being at the audit table or doing tax returns probably wasn't going to get me to ultimately where I wanted to go in life. So I realized, well, how can I get there? So I stumbled upon the book Rich Dad Poor Dad, which very popular book. They talk a lot about real estate. And from there, I realized, okay, I need to invest in real estate. That's something I need to do. So in the summer, in between the time I graduated college, and this is back almost 10 years ago now, I graduated and I was like, okay, let me go to this event. This real estate event it teaches you how to syndicate real estate. So basically you raise capital and you go buy an apartment complex, you add a bunch of value to it, increase its NOI, and then you sell it, right? So I did that right before I got into my first full-time job as an accountant. So that's kind of how I got into real estate, was realizing that being an accountant, solely an accountant, wasn't probably going to get me to where I really wanted to go. Yeah. So I broke into that, and then having the background as an accountant broke me into actually doing tax strategy for real estate investors when I realized the synergies that were there.
I love it, man. And one of the reasons I love real estate investing is because of the tax strategies. Like when I got involved in real estate, all I thought about was cash on cash return. That was like my thing. Like if I can get a certain amount of cash on cash return, I was in. But I didn't realize, and even being as a licensed real estate agent, I didn't realize all the different tax benefits that real estate provides as opposed to other investments. So let's start off by just very basic, like, what are some of the basic tax strategies that are available for real estate investors? And then maybe we can dive deep on some of those strategies.
Absolutely. So I think the first thing probably to lay out the landscape for everybody is just by investing in real estate, you're already putting yourself in a more favorable tax position than a lot of other ways to earn income, right? So say, you're a real estate agent, you're a broker, or maybe you just have a job. You're generally going to be taxed at the ordinary income tax rates up to 37% plus federal taxes. And if you're self-employed, you're adding the 15.3% self-employment tax in there. So you could be taxed easily 50% or more on your income. And now that income becomes very difficult to shelter, the type of ordinary income. There are ways to do it through real estate, and we'll get to that, but it's very, very difficult to shelter that. But with real estate, the rental income is also taxed as ordinary income. However, there's this expense. It's a non-cash expense, meaning it only exists really on paper, called depreciation. And what depreciation does is it's often such a large expense that it puts you at a loss on paper, despite the fact that you're actually generating positive cash flow. So, kind of paint a picture what that might look like. Say you have a rental property and say it's earning, or say it's generating, excuse me, it's generating $10,000 in rental income, right? And let's say you have $5,000 of hard expenses. And by hard expenses, I mean stuff like property taxes, utilities, maintenance, property management fees. This is money actually leaving your pocket. That would put you at net income of about $5,000. Now, in most other businesses, you're going to end up paying taxes on that $5,000. But with real estate, enter this non-cash depreciation expense. Let's just say you have a $6,000 depreciation expense, just for the sake of argument, totally realistic. And at this point, you'd have a loss of $1,000 for tax purposes, meaning you're not paying tax on any of that income. You have this loss now. So that's the first benefit that's available to real estate investors, is the ability to increase your income without increasing the amount of tax that you're paying. And that's thanks to that expense called depreciation.
Now, now the other thing about depreciation, and I didn't learn this, is that whenever you're qualifying for a loan, it's not like an actual loss, meaning like a lot of loan officers will recapture or not recapture, they'll add back on the depreciation, which means it doesn't affect you in terms of qualifying. Like, for example, if I were to lose, if I were to break out even on a business, I wouldn't be able to buy rental properties. But because it's almost like a paper loss, it doesn't really affect you yet in terms of qualifying for more loans. So it achieves that, but you're also able to um, uh, get the write-off as well too, which is, I think, the best of both worlds.
Oh yeah, for sure. So loan officers who are experienced with real estate, they understand that depreciation is a non-cash expense, and really what they're looking for is they're looking: do you have the cash flow, or does the property, rather, in some cases, have the cash flow to support the loan that you're about to get? So and they understand that, hey, depreciation is not impacting your cash flow. If anything, depreciation is actually going to increase your cash flow, because you're not going to be paying taxes on an income, but that's another story. The loan officers is more or less concerned. They look at your tax returns, they look at Schedule E, and they say, okay, depreciation, we know this is non-cash, we're just going to add this back and almost pretend like it's not there.
So the good thing is, it sounds like you can make, let's say, $5,000 net income on that property, meaning it's positive cash flow, and pay $0 in taxes, basically, because potentially because of depreciation, depending on how much depreciation you're getting on that property.
Exactly.
Now, let's go into more advanced strategies of depreciation, because this is the one thing that I've participated in and that has helped me out tremendously. But let's go into some of the more advanced strategies as it relates to depreciation.
Absolutely. So, to start, so back in the Tax Cuts and Jobs Act of 2017, they introduced something called, or reintroduced something rather, called 100% bonus depreciation. And basically, what that allowed you to do is take certain components of your property and depreciate the entire amount in 1 year. So the way depreciation typically works is, say you buy a residential property, you're going to break out the land value from the building value, and you're going to be able to depreciate the building. And now the building for a residential property typically going to be depreciated over 27 and a half years. So more or less, you're taking every year, you're taking basically 1/27th of that and dividing it out, and every year that's your depreciation expense. However, when you buy the building, there's actually more components in it than just the building, right? You have flooring, appliances, it might be pools, decks, things like that, right? So what happens is you can get a cost segregation study performed, which basically breaks out the different components of your property, and certain components have a lower class life. So let's say appliances, for example, have a class life of 5 years, which means that they would be depreciated over a shorter period of time, which would increase your depreciation expense. Same thing. There's like land improvements, like the losing my train of thought here for some reason. The land improvements like pools, decks, underground plumbing systems, those types of things, that's going to be depreciated over a 15-year life, again, shorter than 27 and a half years. But with bonus depreciation, what's really interesting is that if you have the class life of less than 20 years, can be depreciated in its entirety in the first year. Now, that's under 100% bonus depreciation. It's since dropped down. So in 2023, we're looking at 80% bonus depreciation, but generally anywhere between 20 to 30% of a property's value, or purchase price rather, can be reallocated to property with a class life of less than 20 years. So if you're just say you buy a $500,000 property, for example, and you're able to allocate uh, let's call it 25% to property with a class life of less than 20 years, right? So you're looking at that's $125,000. Now, with 100% bonus depreciation, you'd be able to take that entire deduction in the first year. But bonus depreciation 100% ended in 2022. So if you were buying a property in 2023, you're placing the service in 2023, getting it ready to rent out, you're looking at 80% bonus depreciation, which is still $100,000 on that $500,000 property, is example. And that can be quite powerful because if we take back our to go back to our example before, you might have a property that's generating $10,000 or $20,000 in rental income. Now all of a sudden you enter this $100,000 non-cash expense. You combine that with the rest of the expenses you have on the property, and you're easily putting yourself at a significant loss on paper. Now, what you can do, it becomes even more powerful when you can take this loss and use it to offset other income. Now, uh, most losses from rental real estate are going to be passive by default. So what does that mean? When a rental loss is passive by default, it means it can only offset other forms of passive income. A rental income is the main form, but it could also come in the form of businesses that you're invested in as like a limited partner. You don't play an active role in. That's another form of passive income. So what ends up happening for a lot of investors, they'll go ahead and invest. They'll get these huge losses, and then they'll be suspended and carried forward into future years, meaning they're not used. However, if you can qualify as a real estate professional, you can take these losses against your ordinary income that you're earning from a job or an active trade or business, and that's really that's where the real power of bonus depreciation and depreciation in general can come in.
That's awesome. So, and this is kind of how I used it. So, just to give our audience a little bit of a summary, I bought a $4 million building. Let's say 25% of that building classified for less than 20 years. That's $1 million right there. And let's say I made $1 million in my real estate company. That $1 million in bonus depreciation can offset the entire amount of money that you made in your real estate company. Hence, basically wiping out your entire tax liability. If I only made $500,000, then I still have $500,000 left that can be used for the next year after that. So the question becomes, how do you qualify as a real estate professional? Do
Right.
you have to be a licensed real estate broker in order to do that, or do you not?
Okay, so to qualify as to qualify as a real estate professional, you need to spend at least 750 hours in a real property trade or business, and more than half your total time in a real property trade or business. So there's 11 real property trades or businesses. One of them is being a licensed broker or agent. You do not have to be a licensed broker or agent to achieve the status. It certainly helps, but it's not a requirement. You could be working full time as a developer. You could be in construction. You could be fix and flipping. You could just own rental properties. That's what you do full time. Then that's how you're going to be able to qualify as a real estate professional. Now, where I think a lot of people just on the flip side of that, where people run into issues is if you do have a full time job or you are running a business full time that's not a real property trader business, then it becomes very challenging, if not impossible, to qualify. There's been many people who've tried and lost under audit and in tax court. Really, you need to be working full time in real estate to qualify, 750 hours and more than half your total working time. And you don't need to be an agent or broker, but it is one of the 11 real property trades or business, and it can certainly help.
Is there a certain amount of time that you have to invest? Like I've heard that 750 hours or half of the of your time. Can you explain that in a little bit more detail?
Yeah, yeah. So those are the requirements to qualify. So 750 hours in a real property trader business. So if you work 750 hours, say as a real estate agent, you're going to meet that 750 hour requirement. So if you do that full time, and there's a very good chance that you're going to exceed the 750 hours. And more than half your total working time is, say, for example, you spent 750 hours in a real property trader business, but you spent 1,200 hours in a non-real property trader business. Maybe you own a pizzeria. I'm just making this up. But let's say you own that pizzeria and you're not, and you spend more time there than in your real estate business, then you won't qualify. So the two requirements are you need to at minimum spend 750 hours, and then it needs to be more than half your total working time.
What if the husband owns the pizzeria and then the wife has the license
Oh,
for real
that's an
estate?
excellent question. That's an excellent question. Yeah. So, if you're married, the good thing is if one spouse can qualify as a real estate professional, then because you file a joint tax return, you both kind of qualify. So the key distinction there is that you only hours of one spouse counts, right? So, say spouse A owns the pizzeria, they spend their time at the pizzeria, and spouse B is a real estate agent, but say spouse A sometimes helps the agent with their activities, right? So now spouse A is spending, who owns the pizzeria, operates the pizzeria, is helping their other spouse and spending time in a real property trader business. The spouse A's hours does not count. Only spouse B's hours count, or the real estate agent towards the real property trader business towards a 750-hour requirement.
Which I love. And this is one of the reasons why having a good tax professional like you can actually help people, because if the husband or wife is a lawyer, an attorney, doctor, business owner, whatever it is, the other spouse might be able to meet that qualification by getting a real estate license and working as a real estate agent or property management or whatever. So there's different
Yep.
ways to meet the qualifications. It's just a matter of having the right advice and the right guidance, because I've seen clients do it that way. Now you still receive all the tax benefits and you still get to keep your day job or your day business as well too. Anything that we missed about depreciation, real estate professional, bonus depreciation before we move on to the other ones?
Yeah, for the real estate professional stats, I just want to add one more thing in there. So 750 hours and more than half your total work time, that's to qualify as a real estate professional. Now, when to really put the power into it, you need to have the rental properties, and to fully qualify or to take the losses and turn those losses on your properties non-passive, you need to prove that you materially participate in your rental activities. So to kind of give an example, kind of what that looks like, say, you're a real estate agent, you buy a property and you go put a property manager on it and you don't really touch it, right? You're not going to be materially participating. You have to meet there's 7 tests, but there's one of 3 that really matters for most people, and that's either you do substantially everything yourself. So in other words, you buy the property, you're a one person show, you do all the property management, you do everything yourself. Then there's the second one. You spend at least 100, you spend more than 100 hours, and no one other individual spends more time than you. So maybe you sometimes have a handyman come fix the property, or maybe you have uh, say, yeah, you have someone come and do maintenance on it occasionally. That's fine as long as they don't spend more time than you, or you spend more than 500 hours on across your rental property or your rental properties if you have multiple rental properties, to turn those losses non-passive. So the first bar is qualifying as a real estate professional, and that's that, again, 750-hour requirement and more than half total work time. The second is proving that you materially participated in your rental activities by meeting one of those 7 tests, with the 3 that I just mentioned being the ones that are really relevant for majority of taxpayers out there.
Now, what if like it's a triple net property where there isn't really much management? How would that work?
Yeah, that's a great question. So, it might be considered passive if that's what you have, and there's not that much property management going on. Then there might not be many hours for you to get. So I would say if it's triple net, yeah, this is an interesting question, because triple net is usually going to be considered passive. But if you're literally doing everything for the property on the rental activity itself, like managing it, then those hours should count as property. Those hours should count. But yeah, it's just not that much to do on a triple net lease property when you can lease
Yeah.
it to a tenant, and they're going to do majority of the maintenance on the property.
I love it. All right. So let's move on to, we covered depreciation, we covered real estate professional status. What are some other tax strategies that real estate investors can use?
That's a good. Okay, so the next one is we break it down like this, right? So if you look at the first bucket is like you're able to use depreciation to offset your income. The next one is the ability to pull equity out of your property tax free. So let's say some people know this is the BRRRR method, the buy, rent, rehab, refinance, repeat. That method. Basically, what happens is you buy a property, and over time your equity is generally going to increase, right? It's going to increase because you're paying down the principal on your mortgage. You're paying down the market's going to appreciate. You might even be renovating the property to force appreciation, as they call it. Either way, the value of the property goes up, and you can go and refinance your property and pull money out. And when you pull the money out of the property through a cash out refinance, the debt proceeds are not taxable. So, in other words, like, just give an example. Say you bought a property, it was $150,000. You did major renovations to it. Now it's worth $300,000. Well, now you can go and there's $150,000 worth of potential profit there. So you could flip the property, and if you flip the property, you're going to incur either capital gains or ordinary income tax, depending on your situation. But you're still going to incur tax. But instead, if you do a cash out refinance, you might be able to go to the bank and say, you know what, on that $300,000 property, I can, out of that $150,000 I just added, the bank might be willing to give you a loan for 75%. I know that what's going on today might be a little bit different, but just say it's traditional 75%. You're going to be able to get a loan, say, of $112,500, right? That's $112,500 you just pulled out of the property, tax free, that you're able to then go and, say, buy the next property and do it all over again and continue to build your wealth. And so that's kind of another hidden tax benefit I don't think people realize, is the ability to really build your wealth just by doing cash out refinances, which are non-taxable. And if you're using the proceeds for business purposes, like acquiring another property, the interest will also be tax deductible to you.
So, and this is amazing that you're covering this, because sometimes whenever you flip a property, like you're like, yeah, I made $70,000, but if you paid 50% of it in taxes, you really only made $37,000. You could have potentially earned the same amount of money had you just done a cash out refinance. You would have kept the property, which not you would have received depreciation benefits as well too, potentially accelerated depreciation and a bunch of different things. And you got to keep the asset, which generally appreciates over time, and
right.
rents generally go up over time as well too. And then the principal gets paid down as well too. So it's almost like they're working in opposite directions. Prices and rents go up, and then the principal starts getting paid down. So what ends up happening is the gap starts getting bigger and bigger every single month, which is awesome. I actually didn't learn about this strategy probably until like 2017 or 18, having already been in the business for like 8 years. And once I realized that, I was like, oh my God, like, some people may not have to sell. They may be better off just doing a cash out refinance, keeping the property. And then when you die, you get what's called the step up in basis,
Oh
and
yeah.
your kids get to inherit that. So what is a step up in basis? That's also a tax strategy, right?
Yeah, that's a great question. I'll tie this in with another strategy too, to tie this all together as this one big awesome picture of real estate, right? So step up in basis, right? So when you pass away, basically over time what happens is when you buy a property, you're going to depreciate that property, and it's going to reduce your cost basis. So say you buy the property for $500,000, and let's just say that 30 years go by, you completely depreciated the property. It's now worth $800,000. I'm just hopefully more than that, but $800,000 for this example. Well, you have $300,000 of appreciation. That appreciation is to be taxed as a capital gain. And then you're going to have also you're going to have a gain from all the depreciation you took, right? So if the property's let's say if it was $300,000, $375,000 of depreciation you took all throughout all those years, you'd have a gain of $675,000 in total, which is pretty sizable. But when you pass away, what happens is your heirs will receive that at the stepped up basis, which is the fair market value, typically at the date of your death, or it could be 6 months after your death if they elect to do that. But it's at the date of your death, it's at the fair market value, and you eliminate all the capital gains tax you would have paid. So they're extremely lucrative strategy in what some people do, right? And we try this in with the burr strategy. And some people will say, they don't want to sell with the burr. You're doing the cash out refinances. You're buying more properties, but eventually it might make sense to actually sell one of the properties you have because, maybe it has a lot of deferred maintenance, or maybe you got a deal you couldn't refuse, whatever the case is. Well, then you could use a 1031 exchange, and the 1031 exchange, you can continually defer taxes. And what some people do is they'll buy a bunch of properties, continually use 1031 exchanges throughout their life, build up this huge portfolio, and then when they pass away, they'll pass it to the heirs at the stepped up basis, eliminating all the capital gains tax they should have paid. So effectively, they're paying little to no taxes on their real estate portfolio their entire life. And that specific strategy with a 1031 and adding a step up in basis to it, it's called swap till you drop.
You know, it's funny. I wrote here on my piece of paper, flop to you drop, basically. That was what I wrote on my piece of paper right before you said it, which is kind of like the same thing. So, in other words, if you're 95 and you need some money, it may be in your best interest to do a cash out refinance. And then when
Oh
you
yeah,
pass away, your kids get to step up in basis, which means now if they sell, they likely paid no taxes or very little taxes on capital gain taxes, basically. And
right.
does the depreciation recapture get wiped out as well, too?
Yeah, it all gets wiped out. Basically, they receive it. So, say that property was worth $800,000 the date of your death. Well, that's it. Basically, goes to the heir's hands at $800,000. The depreciation clock starts over, and let's just say they were sell it the next day. They're going to have like basically no gain because there's nothing. There's nothing there. We sold for $800,000 the next day, for
Okay.
example.
So let's talk a little bit more about the 1031 exchange. I mean, this all sounds great. Like, can I sell a property today and buy a replacement property 3 years from now, or how does it work?
Yeah. So with a 1031 exchange, so 1031 exchanges, you can only use them on investment properties or properties that are held out for investment. So, in other words, if you buy a property, you intend to flip it, and you're holding it for only a few months, you're not going to be able to use a 1031 exchange in the vast majority of cases. There might be limited exceptions, but most of the time you're not. So, you're going to have to hold the property usually for at least a year or two. In order to substantiate the fact that it is actually an investment property and you're not holding it to flip or holding it for resale. So, happens is you buy a property, you rent it out for a few years or more, and then eventually you decide to sell it. When you do the 1031 exchange, you're going to have, I could break down the rules. Basically, you have a total of 180 days from the date of sale to find at least another replacement property and acquire it. Within that 180 days, you have the first 45 days. You have to identify up. You could identify up to three properties, sometimes more in certain cases, but up to three properties generally that you want to replace. So, what makes the 1031 exchange kind of challenging is that timeline, right? You have 6 months. You have to do it within that 6 months, otherwise it fails, and you have to pay capital gains taxes. And then you have a limited period, the 45-day window, to identify the properties that you want to acquire and replace, right? So um, it usually makes sense when you're doing a 1031 exchange to try to identify those properties before the actual sale is done, so that once you sell the property, the date that happens, you then that 45-day identification window starts. You can already start identifying those properties. You're not scrambling. We see a lot of people who have large capital gains do 1031 exchanges and sometimes rush in to buy a property that might not be the best investment, just because they need to buy something before they run out of time and have to pay these large capital gains taxes.
And the other thing that your real estate agent can use, because we do quite a bit of 1031 exchanges, is that they can write extensions of escrow clauses. So, like, we'll make it like a 60-day escrow, and then we'll make it like the client has the right to extend the escrow up to 90 days in 30-day increments. So, like, it actually buys you time where you've already secured a buyer in you have a buyer secured, committed to your property, but you can extend
Yeah,
it 30, 60, 90 days. So it's a way, because the timeline doesn't start until you close escrow. So
right.
the moment you close escrow, that's when the 45 days start. But if you have clauses in your contract where you can extend it 30, 60, 90 days, then you actually have a much larger window to identify the property, but you've already got the buyer secured as well too. Now, what about a reverse 1031 exchange? Now, this is something that I did, I think probably like 2021. I wasn't aware of it. When I heard about it, I was like mind blown. Are you familiar with a reverse 1031 exchange, and what is it? How does it work?
Yeah, so I know enough to be dangerous. I'm not an absolute expert in this area, but basically, what happens in a reverse 1031 exchange is you identify the property first. So you basically acquire the the replacement property first, and then you basically sell your property, and then you do a flip with that. Basically, it just like it changes hands. And the 1031 exchange intermediaries will be able to handle this for you. But that's pretty much what it is in a nutshell. The mechanics behind it, I haven't done one in a while, so I don't know. I would be able to speak to the specific mechanics, but again, it's basically where you find your replacement property, you acquire that first, and then you sell your property afterwards, and you do the 1031 exchange that way, rather than the traditional exchange where you sell your property and then find the next one.
So it's basically like a 1031 exchange, but it's backwards, basically, where
Right.
you buy the property first. We ended up doing that. We came across a great opportunity where the seller wanted cash. He wanted to close out like in 10 days. We couldn't pass it up. So in a scenario like that, where the seller wants something fast and you have the resources to be able to buy it without selling, you can actually implement this strategy, which is just an additional option for our investor clients so that they can utilize that. The other thing I was going to ask you about is, what about opportunity zones? Like, how do those work? What are they? And how are people structuring those to benefit them in terms of taxes?
Absolutely. So, opportunity zones, very interesting thing they introduced within the Tax Cuts and Jobs Act. Basically, they designated certain areas, census tracts in the country as areas that are like low income and in need of revitalization. So basically, what happens if you invest in one of these areas and you invest in through a qualified opportunity fund, there's a lot of tax benefits that come with it. So I'll focus more on the opportunity fund itself because that's where the tax benefits are. So if you invest in this qualified opportunity fund and there's a bunch of requirements. They have to go acquire properties and either renovate it or build it from the ground up within a certain period of time to qualify. But if they do that and you invest in their fund, there's a few benefits you can get. The first benefit used to be, now this is over, you can't do this anymore, but I wanted to throw this in there because people always ask about it. There's a step up in basis in your original investment. So the way qualified opportunity fund investments work is, say you have a capital gain. You sell a stock or you sell a piece of property, you can take your capital gain, invest it in the qualified opportunity fund. And when you do that, you're going to defer your capital gain until the earlier of the time the qualified opportunity fund liquidates, or you sell your interest, or 2026. So you're going to be able to defer your capital gain. So you're not going to pay tax on it in the year you sell it. That's the first benefit, and that's the benefit that still exists. Now, if you invested before 2019, before the end of 2019, you were able to get a 15% step up in basis in your capital gain if you held it for at least 7 years. So that you can't do that anymore between now and 2026. But let's say you had a $100,000 capital gain, that 15% step up in basis, you'd only pay tax on 85,000. Then there was a 10% step up if you invested within 5 years. So it was 15% total, but then 10% if you invested and held it for 5 years. Same concept. If you were able to hold it for 5 years and this ended in 2021, you were able to basically not have to pay tax on $10,000 in this example. So you'd only pay tax on $90,000 of your capital gain. So that was the initial tax benefit, but there's really something that's even more impactful in there that I think a lot of people overlook. And that is, when you invest your capital gains in the qualified opportunity fund itself, you're able to not pay tax on the gains from the qualified opportunity fund. And here's a very interesting strategy that a developer recently taught me, and I was shocked when I heard this, when I saw the full power of it. Say you take that $100,000 capital gain, you put it in the qualified opportunity fund. Great, you could defer your tax until 2026 on that capital gain. That's not really the real benefit. The real benefit is that qualified opportunity fund can go invest in a property in a qualified opportunity zone and push up that value, say using that Burr method, right? Push it up significantly. The qualified opportunity zone can go do a cash out refinance, do it again and again and again, all the way until 2048. So you can have a massive amount of wealth built up within the qualified opportunity fund. And then when it closes, either by 2048 when you have to close it, or before then, you're eliminating the capital gain on the qualified opportunity fund investment itself, which is really, I think, where the real power of that strategy is.
So, the reason I like this strategy, I almost feel like, okay, some people may say, well, I don't want to flop till I drop. I actually want to be able to use some of my money. So this is a strategy, like if you're in your 50s, 40s, and you're like, well, I want to have all this money available towards retirement. It's a strategy where you can start planning towards that and maybe invest in an opportunity fund and liquidate some of your portfolio into this opportunity fund. That way you have this money available by retirement age and you're minimizing taxes at that time.
Yeah, that's an excellent way to put it. I think a lot of people sometimes get too short sighted with it and focus too much on the step up in basis is now gone in 2023, and okay, I could defer my capital gain, but that's not the real power. Like kind of how you put it is the real power of the strategy, the ability to kind of take some of your chips off the table now. You could defer it for a little bit, but then ultimately grow that capital over the next handful of years or however many years you need it to, and then not pay taxes on that. So it could be an excellent retirement play for sure.
I love it. All right. So we've talked about depreciation, real estate professional status. We've talked about step up in bases. We've talked about 1031 exchanges. We've talked about opportunity zones. Anything else that would be a benefit to real estate investor for taxes?
Hmm. That's a good one. I think we covered many of the big ones. There's one more out there that if some people might be interested in, that's a great alternative to the real estate professional status. That's short-term rentals. There's something known as the short-term rental strategy, or the exception, or the loophole. So basically, kind of going back to what I had mentioned before, when you buy that rental property, it could generate these losses, but they're generally passive unless you can qualify as a real estate professional. Well, there's a carve out in the tax code for short term rentals, where if the rental property has an average stay of 7 days or less, or 30 days or less, if substantial services are provided, so think of like a hotel, daily cleaning, daily breakfast, things like that. Then it's not a rental activity. It's not passive by default. And what that means is you don't need to qualify as a real estate professional to take those losses. You only need to meet one of those three material participation tests I mentioned earlier as well. The 500 hours or more, or spending more than 100 hours and not more, no one else spends more than you, or doing substantially everything yourself. So if you have that short-term rental property, average stay of 7 days or less, or 30 days or less, you provide those substantial services, and you meet one of those tests, you can take the losses from that short-term rental against your active or your ordinary income without needing to be a real estate professional. So that's a really popular strategy right now. We see amongst investors is doing that, and that you could short-term rentals. You could do the BRRRR strategy with that. You could do 1031 exchanges with that. You could do pretty much everything we just mentioned with short-term rentals, and the added benefit of taking those losses against your active income without needing to work full time in real estate.
I love it. So, how important is tax planning, and how could you help our viewers with tax planning?
Yeah, so I mean, I think tax planning is essential because they don't teach taxes in the U.S. Educational system for the most part. You have to go to college, and you have to go through all these fancy classes, and even if you do that, they don't even teach you how to do tax planning. They just teach you how to file tax returns. So it's essential that you speak with a tax advisor or financial advisor and sit down and get a plan in place so that not only for the short term, but also for the long term. So you're covering your bases today, but also out into the future to make sure you're not making any mistakes that could trip you up in the future. So there's a few ways that we're able to help people do that. So the first way is we end up doing one-on-one consulting with a lot of investors. They come in, we take a look at their tax, their financial situation, their goals for the future, what their investment strategy is. We come up with a plan for them, including some of the strategies we just discussed today, to basically minimize their taxes not only now but also into the future. So one-on-one planning is a great way to do it. What we realized, though, is when doing one-on-one tax planning is we couldn't help everybody. Not everybody could afford one-on-one tax planning. Not everybody could. We couldn't hire enough advisors to advise everybody a one-on-one. So we created this insiders community called Tax Smart Insiders, where basically we have a bunch of courses and like a group support where we help people kind of do the same thing, teach them about reps, teach them about short-term rentals, how they can use these different strategies to minimize their taxes, but it's more in a course format and then in like a group Q&A type of situation. So this is kind of the two ways that we're able to help people get a tax plan in place.
I love it. I love it. The best way I've heard it described is the IRS has this rule, this book of rules. And in that book of rules, they tell you what they want to see you invest in. And if you invest in some of those things, they actually provide you with certain tax incentives. So if you learn some of the things that the government wants you to invest in, you receive tax benefits. So, and that's something that Thomas can help you. So if somebody wanted to get in touch with you or your company, what is the best way to do that?
Yeah. So the best way to do that, if you want to work with us one on one, would be go to the realstatecpa.com. You could fill out, basically you could request an initial consultation, and we can kind of walk through how we will be able to help you. If you're not ready to do one on one, or you're just getting started and just kind of want to learn a little bit more about this world, I would suggest going to taxsmartinvestors.com. We have a bunch of courses and free resources there that you could start learning about this stuff, kind of dip your toe in the water, if you will, before you do that cannonball into like a full one-on-one blown tax plan. So those are the two ways you could get in contact and learn more.
Sounds great. I love it. So I want to say thank you, Thomas, for taking the time to be on the show. Obviously, I think that this episode is going to be extremely helpful for anybody watching it. I had a real estate agent that told me that they bought a fourplex one time, and I said, "Great, have you done a cost segregation study?" He looked at me with a blank stare in his eyes and said, "What is that?" I recommended him a person. A year later, I get a random phone call from him. He goes, "Hey, you actually saved me a bunch of money in taxes, and I just want to say thank you and that I am forever grateful." And that to me was like, man, like it felt good to be able to give back. So we hope that this video was helpful to you guys. So for our viewers today, we had Thomas Castelli. He talked about tax strategies for real estate investors. If you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode will be helpful to anybody, make sure to hit that share button. Thank you again, Thomas, and to our viewers, until next time.